Hi friends, Simon here from InformedTrades.com. Today I want to talk a little bit about the case of Daniel Plunkett, a trader at Barclays, who was fined by the FCA, some regulatory authority in Britain, regarding manipulating the gold price in trading against his clients. I think this is an interesting example of how banks can, and in this particular instance actually do, manipulate prices to trade against the clients. I think it's kind of an interesting example of how this can occur, and something that perhaps, in my opinion, actually probably does occur in other markets and other scenarios besides this specific example of the London gold price being manipulated that Plunkett is being fined for. Okay, first, this article, just so you know, I'm not making this up, was reported here on Zero Hedge. Of course, if you don't like Zero Hedge, Zero Hedge is basically just reposting the article that was posted on ft.com. Here it is. Yeah, gold price manipulation was routine, FT reports. Okay, and you see a lot of this is quoting the FT article right here. So there's a link to this article on informedtrades.com and in this video posting beneath in the description area, so you can check it out, read the whole article. But just to summarize, basically what happened here is there's something called the London gold fixed price, the London gold fix. And that's the price of gold that is sort of established twice a day in an auction style in which four banks, big banks, Barclays is one of them, HSBC and a couple others, JP Morgan probably, participate in establishing sort of a fixed price, and that happens twice a day as like the price of gold, and then of course it fluctuates around that throughout the day. That fixed price is that benchmark price, often London gold fix, or it's referred to, that occurs in other instruments too. So there's some exchange rates are fixed twice a day. It's sort of like a we're going to take a snapshot, we're going to take an official rate for the day rather than having the rate moving all around and depending on who you're trading with. Here's sort of the official fixed rate, the official benchmark. That happens in gold, it happens in many other assets. There's a WM Reuters rate that deals with exchange rates. And that's like the thing that is important about these benchmark rates, or why they occur, is that there are many other derivatives. So for instance, if you're placing an options trade and that option expires today, a lot of it may be set to the given benchmark. So maybe if you have an option on euro dollar, they may use some benchmark to determine what is the price of euro dollar for that day, and thus the price when the option expired. And the same thing for gold. So a lot of options, a lot of derivatives are set to the benchmark. They're sort of related to the benchmark, and that's where the manipulation occurs. So in the case of gold, Daniel Plunkett, a trader at Barclays, Barclays sold an option to a client where if the price of gold was above 1558 on a given day, if the gold fixed price, that's the thing, if the gold fixed price was above 1558 on a given day, the trader would win like around £4 million, and Barclays would have to pay that out. So what Barclays does is they sort of manipulate the gold price ahead of that day, ahead of the London gold fixed price on the day the option is expiring. So they need it to, if the customer gets paid out, if the price of gold was above 1558, Barclays is going to try to push it down below 1558. And that's where the manipulation comes in. They can put in a huge sell order to push the fixed price down, and then afterwards they can just buy it right back and send the so that the official price of the next day, the fixed is higher. That's the basic idea behind this manipulation. In this way, Barclays gets to charge their client for selling them an option. They don't have to make a payout. Plunkett or the trader, whoever's selling the option, gets a commission on that. They're not making the payout because it closed, the option expired out of the money. They manipulated the market so the trade was unprofitable. This is an example of what happened, an actual example that Barclays is being fined for. The trader Daniel Plunkett is being fined for it. The customer who had the big option that was set in relation to the London gold fixed price is suing Barclays. So this is an actual example. There are historical examples as well. If you look back, and we have an archive on manipulation on informedtrades.com, WM Reuters, which I mentioned, is exchange rate. Many hedge funds and pension funds that are invested internationally in international equities will look at the WM Reuters rate to set their exchange rate, to calculate the value of their fund based on the exchange rate. And they use that WM Reuters benchmark to do that. So that rate gets manipulated, which in turn affects the value and the price of the pension funds that are investing internationally. So that's sort of an example of how manipulating these key benchmarks can affect derivatives and everything that is sort of dependent upon the benchmark. All the other instruments and assets that are dependent upon the benchmark for calculation. So here's an example anyway of this actually occurring. Does it occur in other markets? We've seen a couple examples already. I think that does. In terms of what it means for traders, I'm not sure it means so much aside from, the knowledge that it occurs. It's kind of a precarious situation because if everything is manipulated, then where do you go? So that's a situation. I do think it's good to be informed about it. Good to monitor these trends, how it's developing, and if you know that some type of if you're trading some derivative, you may at least want to be aware of what benchmarks what you're trading is dependent upon, and how that may impact the trade. Chances are it's not going to impact a huge amount. At least what I've seen is that they're basically just bumping up the cost. The end result is that they're bumping up the cost a little bit for the customer. So you're paying, a few percent more, for instance, than you should. So that's not right, or that's not fair, in the opinion of many people, in my opinion. But I'm not sure what else you could really do. Anyway, I do think it's an important topic, worth discussing, worth studying. If you have any questions, anything you want to add, join us at informedtrades.com. Best of luck in your trading. Take care.